Yeah, welcome. Thanks for joining us. It's the first time we're doing something like this, and like I said, might be a couple of gremlins along the way. It's a learning experience for us, but we would like to do a couple more of these, and we'd welcome input on topics you wanna cover. We thought it was an opportune time to give a couple of tips for tax year end. Just get a few pointers and some help, things to think about before the end of February. Before we start, I do want to just be very clear that we are giving you some tips here, some things to think about. This is not personalized financial advice. This is hints and things you should consider before the end of Feb. It's a deadline that's approaching quickly, and you may need to move a few things around or think about a few things before then. So we just want to give you 4 tips before the end of the tax year, 4 things to consider, and hopefully you go away from this feeling more confident about the end of tax year and understanding what it means and what it means for you, and what you can do before the end of the tax year to optimize your investments. The first thing I want to just bring up is the tax year itself. So what is the tax year? What does it mean? It's kind of a weird concept, I guess, if you're not a finance person or thinking about this regularly, especially if you're new to paying taxes. The tax year runs from the 1st of March every year until the end of February the following year. So you'll often see SARS refer to the tax year as something like tax year 25-26. So that's the current tax year we're in. And what it is just, it's the period that SARS uses to measure your tax. So measure how much tax you owe. So one way to think about it is if you're earning a salary every month and that changes throughout the year, every month when your employer calculates your pay as you earn, they calculate how much tax to deduct. They're basing that on a guess as to how much tax you'll pay for the whole year. They have to assume that you're going to earn the same amount for 12 months. And so that's what they deduct each month. They deduct an amount of tax they calculate based on that assumption. But you could get to the end of the tax year and you had an increase, so you've actually earned more, or you put money into an RA and so you've earned less, and then they have to recalculate your tax. But the cutoff period for those calculations is the end of the tax year. And so that's what the tax year is. It's just a 12-month period, a year, but it's shifted out from what we would call like a calendar year, our normal calendar year. And if anyone on here is a provisional taxpayer, that's particularly important because, with provisional tax, obviously there's a payment due at the end of the tax year based on your calculations of what your tax liability is for the year. Obviously, we all have different tax brackets depending on how much you earn. And it's also worth understanding why you pay tax. You're paying tax on almost any income. So there's exceptions and there's exemptions. But if you're earning a salary, if you're earning interest on investments, if your investments grow through capital growth, so you buy some shares and those shares are worth 100 Rand and at the end of the year they're worth 120, that's capital growth. But whether or not you pay tax on that growth depends on whether you sell those shares. So we'll get into all of that kind of stuff to properly understand what we need to do before the end of the tax year. Another thing just to consider quickly before we get into the actual tips themselves is why we even have to worry about tax. If I'm here worrying about my investments, surely I just put money into investments, I wait for them to grow, and I just try and find the best returning investment. Tax is a really important part of your financial planning. It's essential that you think about tax not only now but in the future, because you can make huge differences to your personal finances if you just structure things correctly to take advantage of how tax is calculated. So as I mentioned, taxes are charged on all the different types of income we get, and you also have tax on, for example, estate duty. So when you die and you pass on your estate, there's taxes imposed there. When you make donations, you have certain allowances, otherwise you pay tax. So it's important to understand all of those things and to try and optimize when you move money around, when you make payments, how you make investments, to try and pay the least tax. So we don't want to break the law. We don't want to evade tax. We want to optimize the way we do things to pay the least tax that we have to, and ensure that we end up with the most money, the most assets available to us in the long term. And so that's why tax is important, and that's why this time of the year it's good to get into a habit. Come out of January and dealing with the December and January season. Come into the start of the new year, get your financial affairs in order. Do a couple of things every year that help you plan for the year ahead. So I'm going to dive straight into the tips. We've only got 4 of them, and I'm going to cover them very briefly. They're not complicated, and hopefully they help you understand a little bit more about what you can be doing now before the end of the tax year to optimize your own personal finances. The first tip that we would give you is to maximize your contributions to a tax-free savings account. So there's a couple of caveats there, and there's a couple of things to understand. But tip number 1, make sure you've got a tax-free savings account, and make sure you're taking advantage of it by putting as much into it before the end of the tax year as you can afford to. It's not as much as you can, but as much as you can afford to. So don't go into debt just to be able to put money into your tax-free savings account. If you have high interest debt, pay that off first. Make sure you have an emergency fund in place before you start making long-term investments. There's a bunch of, just general rules that you should be following around investing that need to apply as well. So again, this is not personalized advice. This is a general guidance that people should be thinking about. And if you're unsure, speak to somebody who knows and can help you out. Contact us at Fynbos if you need more help on this. So the thing to understand about a tax-free savings account is anything you put into it is tax-free after it's invested. So you put money into a tax-free savings account, and that can be invested in ETFs, for example. Those could grow over many years. They could pay out. You could get paid out dividends from your investments. You could sell those many years later at a much higher price and have a capital gain. All of those things that normally would incur tax, you pay no tax on a tax-free savings account. So that sounds fantastic, but really that benefit only really you get the maximum out of that benefit in the long term. So the key with a tax-free savings account is get as much money into it as soon as possible and leave it there to grow. It's a fantastic product to have with money in it growing when you get to retirement. It's not something for short-term saving. Don't be deceived by the name. Now, when the tax-free savings account was introduced in 2015, the law that was promulgated to create the tax-free savings account defined a few limitations. We can't all just put everything we have into a tax-free savings account. You can only put 36,000 Rand a year into a tax-free saver. And so your contributions are limited to that 36,000 a year. And over your lifetime, you have a limit of 500,000 Rand. So best case scenario, you get 36,000 in every year. That'll take you almost 14 years to get to your lifetime limit. And then you leave that money alone until you're much older, you're retired, and you start drawing down on that money, and you pay no tax when you start drawing down on it. So something to think about. If you've got some money lying around now, end of the tax year, make sure you're maximizing your contributions into a tax-free savings account. The difference between putting money into a tax-free and not is huge. As an illustrative example, take a fund like the 10X Total World, returning about 12% a year. If you were putting 36,000 Rand a year into that for 10 years, so let's say just for 10 years, you made 360,000 Rands worth of contributions. At that growth rate, you would have that again just in growth. So you'd have around 740,000 Rand in your investment. So your total investment is now double what you've put in. Now imagine you sell that today. If that wasn't in a tax-free savings account, you'd owe tax on that 300 plus gain. If it's in a tax-free, that's all yours. So it's very easy to see with compounding and over time what a huge difference it makes if your investments are inside this tax-free wrapper. So get as many of your investments inside there as you can, and take advantage of that 36,000 Rand limit that you have each year. The other tax advantaged account that's worth looking at before the end of the tax year is the retirement annuity or RA. And here the advantage is a little bit different. So while an RA also allows you to invest and not pay tax on things once they're invested, you also can reduce your taxable income when you put money into an RA. So what does that actually mean? If you've been earning money throughout the year, and you've been paying tax already on it. So maybe you've been having a PAYE deducted every month from your salary. Chances are you've already paid all your income tax. But that income tax was calculated on the basis that you had a taxable income equal to 12 months of your gross salary. Now, you can reduce your taxable income. So taxable income is the amount of your income that is taxed. And you're allowed to reduce that by taking some of that income and putting it into something like an RA, so a pension or an RA. So if you put a portion of your income into an RA, suddenly the whole calculation has to be done again at the end of the tax year by SARS, and you owe less tax. So you've reduced the amount of income that SARS considers for that calculation, and you owe less tax. So anyone who's a provisional taxpayer who's doing their calculations now, coming up to the end of the tax year, you're probably due to make a payment pretty soon to SARS. You can reduce the amount you owe to SARS immediately by just putting some money into an RA and including that into your calculations. So that's the real beauty of the RA in terms of tax savings today, is it reduces what you pay. The difference between the RA and the tax-free savings account is when you start to take money out of your RA at retirement, then you pay tax on it later. But the advantage here is that money's been sitting in your RA, growing and compounding for many, many years. So you took advantage of the tax-free growth. And when you take it out, the chances are you're retired, your cost of living has reduced, you probably draw it down at a much lower rate than your current income. So you're potentially in a much higher tax bracket now than you would be in the future when you're taking money out of your RA. So there's a lot of tax advantages to using an RA or a pension. So if you have, for example, a pension or a provident already from your employer, a lot of that's already calculated in. But if you've got a lump sum that you can afford to invest now, consider putting that into an RA. That can further decrease your taxable income. There is a limit. You can only decrease your taxable income by 27.5%. and up to a maximum of 350,000 Rand. But unlike the TFSA, where if you go over the limit, you get penalized, with the RA, if you go over the limit in terms of your contributions into the RA, you don't get penalized. Those deductions can be rolled over to next year. So if you had a windfall this year, you got a lot of money suddenly from something, an inheritance, who knows, and you put all of that into an RA, potentially that can add up into some long-term benefits. These calculations can get tricky and complicated, so if you're unsure, definitely worth getting a professional to help you figure this all out, but don't delay on it. Don't sit back and say, well, I'll chat to someone tomorrow. You need to get those contributions into an RA before the end of the month. So excited at this moment to mention that we've launched an RA at Fynbos. So if you are interested in opening a new RA, definitely check out our RA product. It launched earlier this month, and we have a bunch of funds for you to choose from various asset managers. So a good option if you need to get some money into an RA before the end of the tax year, definitely check that out. There's a couple of other advantages to the RA which are not really relevant to the end of tax year, but probably worth mentioning. Anything in your RA is protected from creditors and is excluded from your estate. So that means when you pass away, there's no estate duty on that, what gets passed on. You're also, if you are an entrepreneur, so probably if you're a provisional taxpayer, potentially an entrepreneur, high likelihood that you are stretching yourself financially to make your business work. Anything in your RA is protected from creditors. So if things don't go well, you get into trouble, you owe money, the creditors can't actually come after the funds that are in your RA. And the way the RA works since the two-pot system came in, so you've probably heard this mention of two-pot. That came in just over a year ago. What it means is everything you put into your RA gets split between two pots. One pot is your retirement pot, and that you can't touch until you're 55. And when you get to 55, you have a big lump sum you can take out at the time, but then the rest gets paid out through what's called an annuity. The other is your savings pot. So a third of everything you're putting into your RA, you can actually take out. You can do a withdrawal once a year. There's some minimums there, and depending on the provider, they may charge some fees, but you can take that out once a year, and you'll just pay your nominal tax rate at the time on that money when you take it out. So another good one to look into if you've got money available to invest. Don't delay before the end of the tax year. Look at the tax-free saver and look at the RA. Third tip is probably the most complicated one, and one definitely worth getting some assistance with if this isn't something you feel comfortable doing yourself. And this is for people who have already got some investments. They have a portfolio of shares, whatever the case may be, and that is to make sure you're resetting your cost base. So each year you have an allowance. You can earn some interest, you can earn some capital gain, you can make some capital gains and not pay tax on those. And you need to take advantage of that allowance every year, otherwise you lose it. So the little trick here with the capital gains tax, and that's what CGT stands for, capital gains tax, is to take advantage of the 40,000 Rand a year allowance every year. Now, the trick with capital gains is you don't pay tax unless you realize the gain. So what does that mean? You bought an asset. Let's say you bought some shares, you have a share portfolio, it's worth, 1 million Rand, and it grows to 1.1 million. That's a gain of 100,000 Rand. Now, you're not going to pay tax on that gain unless you actually sell those shares and realize the gain. So if you sell the shares, you now have 1.1 million Rand in cash. You can go to reinvest them straight away in some other shares or in another asset. But as soon as you do that transaction and make that sale, you've realized the gain, and now you owe tax on it. The trick here is to make sure that you don't wait and only realize the gain way, way down the line and only get 1 year's worth of exemption. So your exemption doesn't carry over that 40,000. So I've got a little table here to try and explain how this works. Now, if we take that example I was talking about of 1 million Rand investment, let's say, and let's say for simplicity's sake that every year it's earning about 100,000 Rand it's growing by about 100,000 Rand. So that's, it's probably not realistic. It's a very linear game, but I'm using round numbers to try and explain it. In the savvy scenario where you're taking advantage of your capital gains tax allowance, you're selling some of those shares and paying some tax. So let's say I sold the full share portfolio or rebalanced it. So let's say I sold the shares and bought a similar share or something else. And so now my portfolio is still worth 1.1 million, but because I did a sale transaction, I owe some tax. And based on, let's say the maximum tax rate, I'm going to end up paying about 11,000 Rand in tax. And I do that every year for 5 years. So over the course of 5 years, I keep gaining. My portfolio is now worth 1.5 million Rand. And over that period of time, I paid 55,000 Rand in tax. If I don't realize the gains along the way, so let's say I just leave that money in there to grow, it grows at exactly the same rate. It's worth exactly the same thing after 5 years, 1.5 million Rand, except I decide to sell everything at the end of the 5th year. Now I've realized a gain of 500,000 instead of 100,000 for that 5th year, and I still only get a 40,000 Rand tax exemption. So I pay tax on 460,000 Rand instead of 60,000. And so you can see how my tax bill suddenly is 83,000 at the end, and I've paid a significant amount more tax over those 5 years than I would have if I was just realizing those gains along the way. Again, this is a fairly complicated concept and probably worth getting some assistance with if this isn't something you're comfortable with, but be aware of it. A lot of people who work with financial advisors or are managing their investments themselves aren't doing this every year, and it should be a habit that you're rebalancing your share portfolios or looking at what assets you have that are accumulating a capital gain and thinking about how can I take advantage of the exemption each year. Because if you don't take advantage of it, you don't get to add it on next year. You don't suddenly get an 80,000 Rand exemption next year. And that's an important concept to think about. So if you have a financial advisor, ask them what you can do to take advantage of this capital gain. Maybe you don't have a big enough portfolio yet to take advantage of it, but you can take advantage of some of it. And so what you're doing each time is when you sell those assets and then you buy new assets, the new assets have what's called a new base cost or a new cost base. So instead of being worth having a cost base of 1 million, after year one, they have a cost base of 1.1. So when they get to 1.2 in year two, the gain is only 100,000. That's the thing we're trying to look to do is we're trying to make sure we continue adjusting the cost base up so that in the long term, we pay less tax. We pay a little bit along the way rather than a big lump sum at the end. And if you do that correctly, you can save yourself a lot of money. Fourth and final tip, and this one is not for everyone, but hopefully for most of us, and that is to think about donations. So if you have, public benefit organizations or causes or charities that you want to support, bear in mind that anything you give to a registered PBO is tax deductible. So again, a bit like the RA, you can reduce your taxable income by making donations. You just have to make sure you don't go over 10% of your taxable income. So I think, great habit for all of us to get into if we can donate 10% of our income to good causes. But anything over that is not going to reduce your taxable income anymore. Like the RA though, it does carry over. So if you make a nice big donation this year to a registered PBO and it's more than 10% of your income, remember that will carry over next year. Keep a record of it. The other thing to bear in mind is if you want to make this donation and you want to claim the reduction in your income, you need a Section 18A certificate. So you need to make sure that the organization that you give the donation to is going to issue you a Section 18A certificate, and that'll just detail your tax number and how much you donated, and it'll have their particulars on it, just so that SARS has that on record. And if your employer offers the ability to do this through payroll deductions, that's also something worth exploring, but probably a little bit late to do now at the end of the tax year. So those are the four tips we had for end of the tax year. Make sure you're maximizing your contributions to a TFSA if you can afford it. Same with RA and CGT. If you can afford it, put some money into an RA, reduce your taxable income, either going to help you reduce your provisional tax payment now or potentially get you a tax credit down the line if SARS recalculates your income for the year and finds that you've actually overpaid because you've reduced your taxable income. Look at raising the base cost or the cost base on any existing assets you have, any shares or anything you've invested in today. Don't leave them to just grow for years and years. Make sure you're rebalancing your portfolio. You're thinking about getting that base cost up on an annual basis, just to make sure that you take advantage of that 40,000 Rand exemption. And finally, if you are planning to make donations or give to public benefit organizations, consider doing that now before the end of the tax year. Get your certificate and make sure that donation counts against your current taxable income, potentially earns you quite a nice tax rebate or a refund when your tax is calculated. So that's it from my side. Those are the 4 tax tips we have for you for end of the tax year. Happy to look down in the chat and see if there's any questions, but I think nothing has cropped up so far other than lots of thumbs up. If there are any questions, feel free to drop them in there. Otherwise, we're always open to answering questions through the Fynbos WhatsApp chat or contact us via email. We'd love to hear from you as well, whether you thought this was useful session. We want to do more of these. We want to do a lot more community building stuff this year, getting together as a Fynbos community, helping each other out. At the end of the day, our mission is pretty simple. We want to give people confidence. We want people to feel confident about managing their money, understand what's going on. We're not saying everybody has to do it themselves and that there's no place for getting professional assistance or advice, but everybody should understand what's going on and should feel confident that they're doing the right thing. So thanks very much for joining us, and we'll do this again soon. And don't forget, if you do need to put money into a TFSA, RA, or you want to set up investment accounts, outside of those wrappers as well, check out fynbos.money. We've got all of those accounts available. Thanks very much.